What's up, guys? It's your boy, Quick Stocks. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of
Who's that company? It's
Disney, ticker symbol DIS, trading for $118 a share as of May 22nd, 2020, equating to a market cap of $213 billion and a PE or price per earnings ratio of nearly 40. Let's get it out of the way quick. For transparency's sake, we have a decent sized investment in Walt Disney with a total of 86 shares, which equates to over $10,000 resting on our boy Mickey's oversized ears. So, what's the move? Is it time for us to up our position in the happiest place in the world? Or is it time for us to say farewell to Neverland? This is your quick stock analysis. Unless you've been living under the sea, I'm sure you've noticed that Disney's share prices have been absolutely crushed. Even after a decent recovery, share prices are still trading at a 22% discount from their highs, which technically brings them back to share prices seen in 2015. Just let that sink in. There are shareholders out there who bought into Disney 5 years ago who are down on their position. Of course, not counting dividend payments. It's insanity, man. And this is after Disney has made some crazy acquisitions in the last few years, including Lucasfilms, Maker Studios, BAMTech, 21st Century Fox, after the massive success that is Hulu and Disney Plus, following the hype train that was the Avengers. And this isn't even putting into consideration that interest rates are substantially lower and money is being printed like hotcakes. It's crazy to think how this global pandemic could shut the doors to the castle for the first time in forever. It really is a small world after all. Alright, no more Disney jokes. Here at Quick Stocks, we're all about the simple, bare necessities, and as your humble reporter, I aim to maintain the highest level of integrity. But for real, what's going on? Has everyone lost their mind, or is there a valid reason for Disney to be trading at these fractional levels? Well, what a lot of people don't realize is, out of Disney's $70 billion revenue in 2019, $26 billion came from parks, experiences, and products, meaning Disney's cash flow is heavily tied to its parks and attractions, and the financial impact is highly dependent on the duration of the closures, in which I've seen a ton of people state that they would absolutely love to become a Disney shareholder. However, they want to wait until after next quarter's earnings. Because, let's be real, the company is going to be affected as parks are closed, movie theaters are closed, hotels are closed, cruise ships closed, and sports are canceled. However, hear me out. I'm going to tell you a secret. Shh. This information is not going to be a surprise to anyone. Meaning, no one is going to be surprised when Disney's next quarter is abysmal, which is why I do not think it's going to affect share prices that much. Everyone is already expecting a terrible quarter, and share prices tend to reflect expectations and move up or down based on how those expectations play out. However, what I expect to be a much larger factor for Disney is the quarantine restrictions. As restrictions are starting to ease around the world, investors' expectations could certainly become lofty, as travel will surely be negatively affected even after restrictions are lifted. And reopening theme parks is expected to be a long process, fraught with logistic and public health concerns. And considering parks, experiences, and products was Disney's largest source of income in the last fiscal year, it's something an investor should consider. It seems as if the market had priced in a pretty bleak picture regarding Disney, after dropping past all of its supports, when just last month Walt Disney was trading for only $85 a share. And I must say, congratulations to any of you who picked up shares or executed call or put options in the money before or after the crash. You made out like Robin Hood. However, remember, this is the long run and we are still in the first lap. There is plenty left to climb or even potential volatility. Although it's not all bad news for Disney, with so many people being quarantined at home, its cable and direct-to-consumer business is set to boom. Simply put, Hulu and Disney Plus have decades of massive growth ahead of them. And yes, in a sense, these services are cannibalizing its own market, as these services are potentially accelerating the cable cutting trend. But I don't think anyone is arguing that this was a much needed move to lock in future growth for the company. But what really blows my mind, shameless plug, I talked about my Netflix stock analysis, link in the description. Just a few weeks ago, Netflix's market cap or capitalization surpassed Disney's. Like seriously, WTF, mate. Don't get me wrong, I absolutely love Netflix. However, for the company to be valued at more than Walt Disney, I have a lack of words. I guess most people really don't realize how massive and ingrained Walt Disney is in our life. Low key, I'm about to pump Disney because, well, we need some gains. But no, for real, hear me out. Disney is the king of dopamine dealing. They own partially or entirely ESPN, worth a measly $28 billion. Disney Plus with over 54 million subscribers, and it's less than a year old. Hulu with over 25 million subscribers, as close to a movie franchise monopoly as you can get. With franchises such as Disney Animation behind titles like Moana and Frozen, Pixar with titles like Toy Story and The Incredibles, Marvel Cinematics, the company behind The Avengers and Captain Marvel, Lucasfilms, the franchise that created Star Wars and Indiana Jones, ABC, A&E, the History Channel, Lifetime, Vice Media, Hollywood Records. Disney owns Alien vs. Predator, Avatar, Deadpool, Thor, Black Panther, Lion King, Guardians of the Galaxy, Die Hard, Fantastic Four, Ice Age, Planet of the Apes, X-Men, Pirates of the Caribbean. And I could literally go on all day. Disney's movie collection really is that massive. We've got Disney Retail, all the shirts, action figures, merch that you've seen with any of the characters stated in this video. An insane list of theme and water parks, land holding, attractions, and resorts all around the world. Alright, I'll pump the brakes, let's wrap this up. So, with all of this in mind, what's the move? Well, like I said, we've already got 10 grand invested into Disney, which makes up a little less than 5% of our total portfolio. Which, honestly, considering all the great companies that we are invested in, I'm actually pretty happy with. I completely agree that if you buy into Disney at the sub $120 range, your future self will thank you. However, remember, Disney isn't known for large movements in share price, and the last few months have been an oddity for the company, which certainly still offers a great opportunity for investors who haven't gotten a chance to get a piece of or want to lower their cost base in Disney. Just, one shouldn't expect these crazy movements in the company forever. Yes, obviously if a vaccine or CV worries completely dissipate, expect a large bounce in share price. But for the most part, Disney is a long-term play. Like I said, I am currently happy with my Disney position. However, let's pretend that we see a second wave of lockdowns and we see Disney share prices once again drop below $100. In that case, I will happily double my position in Disney, as Disney is in the dopamine dealing business, which is our favorite type of business. And no one can argue that they have done a great job marketing, and their franchises under their umbrella have become so ingrained in our everyday way of life. I have no doubt that Disney is a great long-term play. Anyways, guys, that's all we've got for today. And as always, the best investment you can make is to go long on Quick Stocks. Hit that subscribe button now at 240 subscribers and plan an early retirement. I'll catch you guys in the next one.